Hi, JJ here with The Art of Value. So what's involved in finding future multi-bagger companies, multi-bagger stocks that can return 10x to 100x in the stock market? And how might we go about finding them? Well, Mohnish Pabrai has some solutions to this. He's been talking about it quite a lot, especially in a recent interview, actually going back a couple of years since he started on this strategy. And the previous episode is about this, is that too. So this is part two. So I'm going to go through some of what Mohnish Pabrai said about this. So he starts off saying John Templeton said any analyst will be wrong 1 out of 3 times. So we have to remember that. So there's a 33% error rate, and that's the lowest. That's the very lowest error rate. Quite often it's higher than that. So he says brain surgeons couldn't get away with that, but investors can. In fact, you can be wrong half the time, and especially if you focus on multi-bagger stocks, companies that can grow that much, you can be wrong quite a lot of the time, because you only need 2, 3, 400 baggers. If you get that much in a lifetime, really only one is all you need. But let's hear what Mohnish has to say about this.
There are a couple of data points. John Templeton used to say that the very best value investor or analyst will be wrong 1 out of 3 times. Like 33% error rate is the lowest error rate for the very best practitioner of the art. If you were a kind of brain surgeon and you had even a 3% error rate, there might not be too many people coming to you for brain surgery. But I think in terms of value investing, you could be wrong half the time. And I think I've probably been wrong close to half the time and still end up with a phenomenal track record. So, and especially if you focus on the multi-baggers, companies that would go up 10x or 100x, basically in a lifetime of investing, if you ended up finding just 2 or 3 or 4 100 baggers at the age that you're at right now, that's all you need. In many cases, if you just found one, that might be all you need.
Yeah, so he's talking to students here. That's why he says at the age you're at now. So the point is that you can be wrong quite a lot and still be right over the long term. And so next up, he says that he gives an example of he made 2 bets that were 100 baggers, and at the time in his whole group of stocks he was investing in, they were responsible for 80 to 90% of the gains, and the rest didn't matter. They could have gone to zero. So multi-baggers can tolerate a high error rate and still work out very well. But the objective, of course, would be not to be wrong. Not to be wrong on the stock. So he talks about how a bit later coming up talks about how not to be wrong. But let's see what he says about that.
Quite a bit, because one of those bets had gone up 100x. 100,000 became about 10 million or so. So anyway, the thing is that even with a lot of sloppiness, what I'm saying is that basically what when you look at that investing that took place then, just the 2 bets that were 100 bagger were responsible for like 80-90% of the returns. It didn't matter. The rest didn't matter if it all went to zero. The results would have still been great. And so that's the nature of this multi-bagger type investing, is that it can tolerate a very high error rate. And of course, your objective as an analyst should be to try to keep the error rate as low as possible.
Okay, so next he talks about how to go about finding these. One of the most important things to keep in mind, one of the most important, is to ask yourself the question, do I understand the business? Is the business within my circle of competence? So if you are investing in, say, it's like Warren Buffett has talked about, he doesn't invest in the cloud because he knows enough about the cloud to understand that he doesn't know enough about the cloud. That's almost a direct quote that I did as a short video actually the other day. That's why it's fresh in my mind. And so Pabrai says, if it's in your circle of competence, then by definition you'll know what the future of the business is likely to look like, the trajectory, the cash flows. Then you have a basis to try and make an investment. So there's no point trying to just otherwise you're just speculating if you don't understand the business. That's important about how to go about finding multi-baggers. Let's see what he has to say in his own words.
The first question to ask yourself is, do I understand the business? And is the business within my circle of competence? And if you understand the business and the business is within your circle of competence, then by definition, you know with some boundaries what the future of the business is likely to look like. and what the trajectory is likely to look at, what the cash flows are likely to look like. And I think if you can put some boundaries around that, then you have a basis to make an investment in.
Okay. So next he says that most investors would be better off ignoring the macro environment. So right now, if you're watching this video in July 2022, and possibly if you're watching it later, it could be similar. There's always something on the macro that's concerning, but you can't guess what's going to happen with interest rates, with inflation, with wars, pandemics, whatever. So the most important thing is to look at the business itself, and Warren Buffett has said this too. So it depends on the business. Focus on finding great businesses. That's how to basically find multi-baggers, just to understand the business and find good businesses that can grow for a long time and that they're great businesses. And he gives the example of Starbucks. He says Starbucks, for example, has done well through thick and thin over decades, right? No matter what was going on, it came out on top, and so it's important about the business. So let's see what he has to say about that.
Most investors would be better off completely ignored everything macro. So for example, if I had a viewpoint of kind of what would happen to Starbucks 20 years ago, it really doesn't matter what the rates are and what the Fed is doing and what financial crisis is happening or whatever else is happening. At the core, the Starbucks business is such that when they open a store in the US, they get their money back in 2 years, 35% return on capital. They don't franchise any stores. And when they open a store in China, they get their money back in 15 months, like something like 70% return on capital. And I mean, they have found, for example, that if they have one store in Manhattan in a particular intersection and they put another store diagonal from that store, it doesn't even cannibalize the first store when the second store is so close. And so it's an incredible business. So I think that if one focuses on understanding the business and is able to identify great businesses, that should be where the focus is.
Okay, identifying great businesses is the most important. Interesting example there of Starbucks saying that it's so good that they can open a store on adjacent corners in New York and still do well. And of course in China they're expanding, so it's kind of expanding internationally, which isn't difficult, isn't easy to do for any kind of American company to go worldwide. There haven't actually been that many successes like that, worldwide businesses. Even Amazon is not like that really. But there have been a few. McDonald's, of course, these examples that he talks about. He talks about that McDonald's next, actually. So he says it's important to be right on the business, to be correct. So that's another important thing for how to find multi-baggers. You've got to be right, and so you've got to understand the business and do work on the business. So it's important to be right. He says if you were early on McDonald's, Walmart, Visa, MasterCard, you would have done well because they had such long runways for growth, and that will transcend everything, the macro environment. That's not to say there aren't macro investors. I did an episode a while ago on Stanley Druckenmiller, who's mainly a macro investor and has been very successful at it, but it's so few and far between, and it's really, really difficult. So he said you can find great businesses. You can find those great businesses. You can buy them early. If you can do this, you can be patient and wait through thick and thin. But the other thing is that a lot of people aren't patient. They might sell too early when there's a macro problem, sort of freak out and sell. So holding for the long term. So let's see what Pabrai has to say about that.
So I think it's very important to be right on the business. If you were early on McDonald's and Walmart or any of these, MasterCard, Visa, whatever, Coke and so on. I think the thing is that, some of these, long runways, they will transcend everything. That's the key, is can you find these great businesses? Can you find them early enough? Can you buy them at decent prices? And then can you be patient through thick and thin?
All right, so there you go. So the last thing that I've got is conviction. So the last thing that's really important, and it's not the last thing because there was a previous episode that talked about other things. There are a lot of other things. So go back and see my previous episode to see more from Pabrai about multibaggers. But he says that conviction is really important. But how do you get conviction? How do you get conviction on companies? So if the market goes down 50%, how do you not sell? How do you stay, because you're so sure? Well, you have to have a strong understanding of the business. So at Starbucks or whatever, you have to really understand everything that goes on in the business, that they're going to make it through a recession, or they're going to make it through high inflation or a tough environment. And so you can build up conviction that way and just hold for the long term over decades without selling. All right, let's see what he has to say about that.
Conviction is really important. And how do you get conviction? I mean, I think you get conviction because you have a very strong understanding of the business.
Short and sweet. Okay, strong understanding of the business. Okay, so that's all for now. But there'll be more in the future about multi-baggers and how to find them from great investors. And so follow and subscribe wherever you're watching or listening to this for more. And join me on Twitter at The Art of Value. Okay, thanks for watching. I appreciate what you watching or listening to this. Things. See you next time.